As well as selling a non-current asset when we're done with it, we can also trade it in. So when we trade it in, we're going to need to add in one more step to our procedure of disposal. So we've got step one, transfer the historical cost of the asset. That's the actual same as with a sale. Step two, transfer the accumulated depreciation. That's exactly the same as the other procedure as well. Then we're going to add in a new step, record the trade-in allowance. So we'll talk about what that is in a second. Step four will be the same, figure out whether we made a profit or a loss on disposal. And then we've got a new step, record the purchase of the new asset in the sundry creditor account. So let's go through this by way of an example. We've got a computer that we bought at the start of 2015 for $10,000. We depreciated in 2015 for $2,000, which leaves a carrying value of $8,000. 2016 we depreciate $1,000, which leaves a carrying value of $7,000, and in 2017 we depreciate $500, which leaves a carrying value of $6,500. So we are going to dispose of the computer at the end of 2017, but we're not going to sell it. What we're going to do is trade it in for $7,500, and what we're going to do is then buy a new computer for $12,000 plus GST, and what we get off the cost of the new computer is the trade-in for the old computer. Let's look at the ledgers though as they would appear. So just to explain what's happened when we dispose of the laptop, we've got a $10,000 laptop. When we dispose of it, it's got a carrying value of $6,500, so we've depreciated $3,500 of it, but we're going to dispose of it for $7,500. So we've actually made a slight gain on disposal there, a profit of $1,000, which will be a revenue. Let's look at the ledgers. We've got a debit here for in the computer account of $10,000. In accumulated depreciation, we'd have $2,000 for 2015. 2016, we'd have $1,000. And in 2017, we'd have $500. So that'll take us up to date with our ledgers. We can now start to record our disposal. We've got this $7,500 trade-in. Where would that go? It's going to be a debit, but we need to give it the ledger a name. We don't know what that would be. Now, when we did the sale of a non-current asset, this account was called cash. But we don't know what it is yet because it's not cash. We're not going to actually get any money. We're going to get a trade-in allowance. So we'll need to figure that out. We'll also need to figure in that if we buy a new laptop here for $12,000, well, that's actually going to go and increase our computer account again. We're going to have another laptop worth $12,000. So we better figure out how to do that too. So let's follow our procedure. Step one, transfer the historical cost of the asset to the disposal of asset account. That means we've got the old computer sitting here. It's worth $10,000. We've got to close that down to zero. And we'll do that by sending it as a debit to the disposal of computer account. So we'll do that in the general journal. We'll do a debit to disposal of computer and a credit to the computer ledger, like so. You can see now the computer ledger is reset to zero. We have a blank computer ledger because we don't own the computer anymore. Step two, transfer the accumulated depreciation. We have charged a total amount of depreciation of $3,500. We don't need to keep this ledger going. If we're going to dispose of that asset, we might as well get rid of the accumulated depreciation account as well. So we'll do a debit there, and then we'll send that as a credit over here. So we'll do a debit for $3,500 to accumulated depreciation, which we figured out by adding up these three numbers. And we sent that as a credit to disposal of computer. And we note that the accumulated depreciation account has now been reset back to zero. It doesn't exist anymore because we've sold this computer. Step three is a new step. That is where we record a trade-in allowance given for the old asset. What does that mean? It means we've got the old computer. It cost $10,000 at a carrying value of $6,500. We're going to buy a new computer for $12,000 plus GST. So we traded, and then what the dealer did, Cons Computers, so the person that we're buying this from is over here, Cons Computers. Cons Computers gave us a trade-in allowance of $7,500. So looking at what we're going to owe Cons Computers, we're going to owe him $13,200 less the trade-in allowance he gave us, which means we'll owe him $5,700. So step three is we need to record this trade-in allowance. So what we're going to do is do a debit to the sundry creditor account, cons computers, and then a credit to disposal of computer. Now, why have we done that? Well, when we did a sale of a non-current asset, this entry here actually went in the cash ledger. Cash went up. Cash is an asset. But this time, we're actually going to owe him money for the new computer. What we're doing here is decreasing the amount we'll owe him. What will happen eventually is we'll do a debit there because we're going to owe him $13,200 for the new laptop plus GST. So what we better do is offset that with a debit like so. So we actually sort of factor in the amount that we've been given as a trade-in allowance. So if we do this entry here, we can see that we're actually not going to owe him $13,200. We're going to owe him $13,200 less this trade-in allowance here. Step 4 is the same as when we recorded the sale of a non-current asset. Figure out whether we made a profit or a loss. So we figured out we made a profit on disposal of $1,000. That is a revenue. So revenues go up on the credit side over here, but we'll need to match it up with a debit into the disposal of asset, or in this case computer account. So debit there to disposal of computer, credit here into the profit on disposal. Now at the end of the period, this is a revenue account, this is profit on disposal, so we better shut that down by sending it to the profit and loss summary account, reset it to 0, and then we'll see our disposal of computer account down here is actually now going to equal 0. It balances out. We've got $11,000 on each side, and that's the way it should be because this is an account that only exists for one day. Once we're done with it, we need to reset it to 0. Let's look at where that profit on disposal would go. So we had a profit of $1,000. That goes with our other revenue. So we covered that in a previous video. It's not regular revenue, it's an other revenue. So we'd put it in with any interest or commission or discounts that we would get. Step 5, record the purchase of the new asset in the sundry creditor account. So Con has sold us a new computer. We've factored in that we've disposed of the old computer. It's gone. You can see there it is there. It doesn't exist anymore. But we did buy a new one. So let's put that in. We've got a new laptop for $12,000. Cons charges GST, so we better do a debit there. And we owe Con $13,200. Now the beauty of this is we don't actually owe him that amount because in a previous step we already put in this $7,500. So now his ledger will actually be correct. What we'll see is if we go to the next slide, the amount we owed him was $13,200 less the trade-in of $7,500. We're only going to owe him $5,700. So we had a step there where we added in the new computer plus GST. We'd already done the debit for the trade-in, which was $7,500. If you balance that out, we're actually going to only owe Con $5,700, and that's correct. That's how much we should owe him after we factored in the trade-in allowance.